Welcome back to Investing Talk Podcast. Today we're looking at what feels like maybe one of the most contradictory earnings reports coming up, American Airlines Group.
Yeah, their Q3 2025 results are due soon, and it really sets up a key conflict, doesn't it?
It really does. We've got a whole stack of sources here, and our goal today is to cut through it all and figure out the core question. Can that high-margin loyalty business, the A-Advantage program, really hold up against what looks like a pretty tough cost environment?
That's the million-dollar question, or maybe $1 billion in this case.
Before we jump into the numbers, just a quick reminder for you listening. Please do subscribe, like the show, and drop us a comment below.
Yeah, definitely let us know.
And hey, if there's a specific company you want us to analyze in a future segment, just put the name in the comments. We actually read those.
We do appreciate the suggestions.
Okay, let's set the scene. We're talking third quarter 2025, the period ending September 30th. When do these numbers actually hit the street?
You'll want to be ready early on Thursday, October 24th. It's scheduled for before the market opens, probably around 8:30 a.m. Eastern Time.
8:30 a.m. Got it. So let's start with revenue. This is supposed to be their peak travel quarter. What's the consensus?
The street's looking for about $13.9 billion. Now, that is up year over year, maybe 3.5% compared to Q3 last year.
Okay, 3.5% growth sounds all right.
It does, but here's the catch. It's actually down a bit from the $14.4 billion they posted in Q2 of this year, which was a record.
So even in the peak summer quarter, maybe slight sequential cooling?
Seems that way.
Yeah.
Suggests the absolute peak demand might be just slightly softening, perhaps.
Okay, revenue stable-ish, maybe plateauing a bit.
Yeah.
But then we get to earnings per share, non-GAAP EPS. And this is where things get, well, kind of wild. What's the number?
Yeah, this is the shocking part. The consensus non-GAAP EPS is just 7 cents, 0.7 cents.
7 cents compared to last year.
Right. Last year in Q3, they reported $0.15. So analysts are expecting earnings to basically get cut in half, even with revenue technically growing year over year.
Wow. Okay, and this isn't just a low number in isolation, is it? This comes after management themselves were guiding much higher not long ago.
Exactly. That's what makes this so dramatic. In their Q2 report, American's own guidance for Q3 adjusted EPS was pretty robust. They said $0.50 to $1 per share. 50
cents to $1. And now the consensus is 7 cents.
It's a massive retreat. Analyst estimates have just collapsed. They've fallen, get this, 53% in just the past month, dropping from $0.15 down to that $0.07 consensus we see now.
A 53% cut in 30 days, that's not just analysts getting a bit nervous. That suggests they see something fundamental changing.
It really does. It signals, a major shift likely on the cost side that the market didn't fully grasp when that initial guidance came out. And the analysts themselves, they can't even agree.
What do you mean?
Well, there's huge disagreement, what we call high consensus dispersion. The most optimistic analyst estimate is for $0.22 EPS.
Okay, still way below the original guide, but positive.
Right.
Yeah.
But the lowest estimate is a loss of 19 cents per share. So $0.19.
Whoa. So the range is over 40 cents wide.
Precisely. That kind of spread tells you just how much uncertainty is baked into this number. Nobody seems quite sure how bad, or maybe not so bad, it will be.
That definitely sets the stage for volatility. And looking back, American Airlines stock tends to react strongly to earnings anyway, doesn't it?
Oh, absolutely. Their track record recently is pretty mixed. Q2 2025 was a beat, which was good.
Right.
But Q1 2025 and Q4 2024 before that, both were misses, and the stock price reaction reflects that inconsistency. Q3 last year saw a decent pop, like plus 3.5% the next day, but Q1 this year led to a negative 4.0% drop. So investors are clearly watching closely and react quickly both ways.
Okay, so Q3 is usually their strongest quarter, seasonally, peak travel and all that. You really need a good Q3. But the headwinds seem pretty intense. What's squeezing the margins here?
It's coming from both sides, really. On the revenue side, domestically, fares have been kind of flat, maybe even down slightly, like -2% year over year. Lots of promotional activity keeping prices in check.
So, not much pricing power at home. But the costs. That must be the bigger story driving that terrible EPS forecast.
That's where the real pressure is. Two big things. First, jet fuel. Prices are up about 10% compared to last year. For an airline this size, that's a huge hit to the bottom line.
10% is significant. And the second factor?
Labor. This is really key. They're dealing with ongoing and probably intense labor negotiations. Getting new union contracts settled is critical for legacy carriers, and the potential cost increases create massive uncertainty about future expenses.
So that cautious tone from management and pulling the full-year guide earlier, that was likely tied to the labor uncertainty as much as anything else.
Almost certainly. It introduces a huge variable into their cost structure going forward.
And didn't they also have that cyber issue during the quarter with the subsidiary?
Yes, Envoy Air, back in August, they had a data breach involving an Oracle system led to a ransomware situation. Now, to be clear, they stated it was isolated to back office stuff, no customer data or flight ops affected.
Okay, so not a direct operational hit, but still a cost.
Exactly. It highlights risks, probably forces some unplanned IT spending to shore things up. Just another little pressure point in an already tight environment.
Okay, so with domestic fares flat and costs, especially fuel and potentially labor, soaring, where's the good news? How is revenue still projected near $14 billion? This is that paradox we mentioned.
It is. The resilience is really coming from two main areas, international travel and their loyalty program.
International first. How's that looking?
Very strong, actually. Across the whole sector, international passenger traffic was up about 8.5% year over year. And U.S. carriers, like American, are really benefiting from that, especially on, the higher fare long-haul routes.
Okay, so strong demand overseas is helping offset weaker domestic pricing. And the loyalty program, AAdvantage, you called it a goldmine earlier.
It pretty much is. Q2 data showed Advantage revenue was up a solid 7% year over year. That's high-margin, sticky revenue. It suggests their premium loyal customer base isn't pulling back spending yet.
That seems crucial for cushioning the blow from fuel costs.
Absolutely essential. And they're leaning into it. They announced that expanded credit card deal with Citi back on July 1st. Okay, it doesn't really kick in until 2026, but it signals how vital that loyalty stream is to their future strategy.
Makes sense. And the split-week domestic costs versus strong international loyalty, that's probably why analysts are so divided right now.
Easily, you see it in the ratings. Bank of America looked at the fuel, the capacity constraints, the labor risk, and they cut their rating to neutral.
Okay, focusing on the risks.
Yeah.
But then you have Deutsche Bank.
Right. Deutsche Bank is sticking with a buy rating and a $17 price target.
Wait, how can they justify a buy with that massive EPS estimate cut we just talked about? Are they ignoring the costs?
Their argument hinges almost entirely on the power of that loyalty program and the international strength. They basically see the AAdvantage program as this incredibly valuable, almost recession-resistant asset that outweighs the short-term operational headwinds.
Fascinating. So it's a real clash of perspectives. For listeners trying to figure this out on Thursday, what are the specific data points they need to zero in on?
Two key metrics based on this whole setup. First, international unit revenue. That tells you how much they're making per passenger mile flown internationally. If that's strong, it confirms they're capitalizing on that overseas demand.
Okay, international unit revenue. And second,
Advantage loyalty revenue. We need to see if that 7% growth from Q2 continued or, importantly, if it slowed down. If loyalty falters, that Deutsche Bank bull case takes a serious hit.
got it. International unit revenue and AAdvantage growth. Those are the battlegrounds. Now, let's shift to the market's expectation. How's the options market pricing this uncertainty?
The market is definitely braced for a significant move. We look at implied volatility, or IV. For American Airlines, IV is pretty high right now. It's in the 72nd percentile.
72nd percentile. What does that mean in simple terms?
It means that based on historical moves, the stock has moved less after earnings than the market is currently predicting about 72% of the time. So expectations for a swing are elevated.
How big a swing are we talking?
The calculation based on options pricing suggests an expected move of about plus or minus 7.2% in the stock price right after the report comes out.
Wow, 7.2%. That's a big expected jump or drop for a major airline.
It really shows the level of uncertainty, and the stock itself is trading near support right around that $13 to $13.20 level. A miss could easily test that support.
Okay, let's try to synthesize this. We have the deep estimate cuts, the macro pressures, strong international, but this high IV. Our leaning heading into Thursday is sort of neutral, maybe slightly bearish given the recent trend. How does the potential scenarios break down?
Yeah, our base case, maybe a 60% probability, is that things land roughly in line with these lowered expectations. So revenue around $13.8 to $14.0 and EPS somewhere between, say, 0 and 10 cents.
And the market reaction in that case?
Probably a move within that expected range, maybe NI 3% to 6%. Basically, the international strength manages to just about offset the headwinds, meeting the lowered bar.
Okay, that's the most likely. What about the bear case?
Yeah.
We have that at 20% probability. What triggers a big drop?
The bear case is all about costs running hotter than feared. If fuel burn is worse, or if the commentary around labor talks sounds particularly expensive or drawn out, you could see significant margin compression. That could lead to a drop of, say, -7% to maybe even 13%.
Ouch. Testing that $13 support level for sure.
Mm.
Looking beyond Thursday's report, what else should investors keep an eye on over the next, say, 3 months?
Well, there are a few things on the calendar. November 10th has a major U.S. ETF rebalancing event, which can sometimes impact trading flows.
Okay.
Then around November 22nd, we should get operational reports covering the Thanksgiving holiday travel period. That's a really key early indicator for how Q4 demand is shaping up.
Right, the first big holiday test. What about institutional money?
December 5th is when the big funds have to disclose their holdings. So we'll see how the major players position themselves heading into year-end and for 2026.
And any other sort of background noise or rumors?
There's always chatter in the airline sector, isn't there? Things like potential strategic alliances, maybe fleet adjustments to manage costs, and, the perennial M&A speculation never fully goes away.
Always something bubbling under the surface. Okay, this has been really helpful in framing the report. It really boils down to this core tension, doesn't it? America needs its star performers' international routes and that AAdvantage loyalty machine to really shine, maybe even over-deliver, just to fight off those rising fuel costs and the big unknown of future labor expenses.
That's it, exactly. The margin for error feels incredibly thin, which is why you see that high 7.2% implied move priced in. And maybe here's a final thought for you to mull over.
Go for it.
Given that volatility and knowing that labor is probably the biggest uncertainty hanging over future costs, what specific comment or detail about those negotiations could come out in the conference call that might cause a really negative surprise? Something that even the current low $0.7 consensus hasn't fully captured. And on the flip side, what if that strong international demand starts to fade faster than expected as we head into the winter? That could hit their main source of resilience right when cost pressures are peaking.
Yeah, the commentary around labor costs and the durability of international demand, those definitely feel like the swing factors. Great points to consider. That's where we'll leave it for today. Thanks for tuning in to Investing Talk podcast. We'll be watching those American Airlines numbers very closely on Thursday morning.